Good morning. Welcome to the Australian Early Finance Briefing for Friday, the 31st of July. My name's Nick Hurley here in virus-riddled Melbourne. Starting with where we left off yesterday, we had the new home building approvals reading come out, and that was much worse than expected. So it was a 4.9% decline. The consensus expectation was only a 1.3% decline, and that was on top of, I think it was a 4.4% decline for May. The CommSec analysts have said council approvals to build new homes were at the lowest in 8 years during June. And the Housing Industry Association senior economist has said the lift in sales following the announcement of the federal government's home builder scheme will become evident in approvals data later this year. Building approvals data will continue to fall for a number of months before home builder halts the decline. There was an uptick in major home renovations, and the general consensus is that that was driven by people being at home and wanting to pop down to Bunnings and improve where they're spending all their time. Yesterday, we touched on the dependency of Australia on China's demand for our exports. The ABS came out with some information yesterday showing that our dependency on China has actually even got bigger. So China's share of Australia's goods export, so that's not services such as university educations, has risen from 35% in February to 40% in April, and then a record 46% in June. So that's almost half of all our exports go to one customer. That share is greater than Australia's entire goods exports to all our combined OECD trading partners, and more than 3.5 times greater than our next most important trading partner, Japan. And its share has declined from 15% in February to 13% in June. Interestingly, the US has actually grown, so their share of our exports has risen from 4.3% to 7.7% in June. Now, as we've mentioned in a number of episodes recently, China's sort of growth in their share of our export demand is driven primarily through iron ore, and that's had some really positive impacts recently. So we're seeing renewed mining investment. It's actually back into growth compared to most of the last decade, particularly gold mining as well. So miners boosted spending in the last 12 months, ending in June, for the first time in 7 years, and that is expected to swell by 9.5% in this current financial year. So Australia's gold export volume, so that's volume not price, which obviously will be much more as a result of the surging gold price, is expected to surge by 15% this financial year, and there's going to be a lot more gold exploration, and we're even seeing that here in Victoria. So that's going to be sort of the favourable part of our resource industry in this coming year. Less favourably is our natural gas exports. So the French energy major Total has written down a 1.1 Australian billion dollar write down to its gas assets. Now, Total owns stakes in the gas plant in Darwin and Santos's GLNG export plant. Now, joining Total, we've had Woodside, Shell, Origin, and Oil Search this month all slash their assumptions for oil, and that's led to 22 billion Australian dollars being written off our gas projects, which isn't a great sign when it's been such a strong source of our resources or energy growth in the recent decade. So yesterday we had US Federal Reserve President Jerome Powell make a statement. He didn't come out with anything too new to what we've known already. They didn't mention anything about yield curve control. They have mentioned that they're going to extend a special repo facility and FX swap lines to ensure adequate onshore and offshore US dollar liquidity. They've extended that from the September quarter to the March quarter next year. They also touched on some of the work they were doing before the corona crisis, and that was sort of providing a more sort of structured and transparent guidance framework. So it's to provide stronger guidance about the path of interest rates by linking the timing of future rate increases to specific thresholds for unemployment and inflation. So he mentioned that to a very large extent, the changes we'll make to the statement of longer run goals and monetary policy strategy are really codifying the way we're already acting with our policies. This is just a way of acknowledging that and putting them in a document, but he's not putting a timeline on that. Now, on his sort of views for the US economy, he said that not all sectors of the economy have started weakening again, citing the housing sector as a bright spot. On the balance, it looks like the data are pointing to a slowing in the pace of recovery. Then it was too soon to say how large or sustained this pause would last. Interestingly, he mentioned that the Fed was not pinning its hopes on a medical breakthrough with a vaccine. Our job is not to plan for the upside case. The upside case, we've got that covered, he said. Rather, the Fed will hope for the best and plan for the worst. So as a result of this announcement, we saw US stocks go up yesterday, and interestingly, there's this term being called the TINA effect, the TINA effect, and that's shorthand for there is no alternative to stocks. Dare I say, I'd probably throw gold in with that as well. And moving to the markets now, the US is off a fair bit. Just after the open, we're seeing the S&P down about 1.5% and the Nasdaq down 1%. Oil's off and gold's off a little bit as well. We'll probably see the US dollar, it's a little bit stronger, typical risk-off trade. Interestingly, we have a lot of the big tech companies coming out with their quarterly results later today. That's Apple, Amazon, Alphabet, and Facebook. So that's, if you was to throw in Microsoft, that would be 22% of the S&P market valuation reporting just there. In Australia, we have the Producer Price Index, which is sort of another manufacturing measure of prices, and private sector credit coming out later this morning. And that is your early finance briefing for Friday. Have a lovely day.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.